So I think we will get underway. Happy Friday. It's definitely a beautiful Friday morning in the Midwest. We're hailing out of Lincoln, Nebraska, and yeah, it's great to have an opportunity to talk about tax minimization today. So my name is Brad Rourke, and I've been with the Williams Group for 17 years now. I joined the company in 2003. And I'm a CPA, and I run our accounting and tax and payroll service for our clients. And then I'm also involved with private equity. I'm an accredited business valuation. That's what that ABV is, accredited business valuator. So I've got a pretty broad background in optometry, and the accounting and tax work we do is only for optometrists. So my knowledge is reasonably good, I think, with respect to the tax issues that optometrists face. So yeah, quite frankly, I love tax. It's great. U.S. tax is we have an extremely complex business environment and society. So our tax laws are commensurate with that. Very, very, very complicated. And I kind of support the idea. A lot of people say, well, we should have a flat tax. However, the problem with flat tax is that there's a couple different purposes for taxation, and one is social policies, and to influence certain industries that we have. And so a flat tax is, in my view, not necessarily the best way to go. Plus, it's going to put all us accountants and lawyers and whatnot on the jobs, but that's not the real reason. We certainly need a fair tax system, and we're endeavoring. Certainly, Congress is endeavoring to do that. So let's move forward here. And so what we're going to do today is we're going to talk about as it says there, clinic tax structures and then tax rates. Just go over a few of the common clinic or corporate tax structures we see, and then I'm going to present what I think is the optimal tax structure for clinics. And then we're going to discuss 9 different tax minimization strategies. And then yesterday was the first time I did this particular webinar, so I took up a whole hour. So there's going to be a lot of content here, and so some of it might be just not over your heads intellectually, that's for sure, but just maybe not familiar with some of the things I'm going to talk about. So we're going to go through it pretty quickly. So don't worry too much if you don't understand it. We talked about yesterday doing a webinar on each of these things potentially, because the content here, probably do a webinar on all the 9 tax strategies and also the corporate structures without any issue. So don't worry if some of the stuff is well, I had no idea what Rourke or Brad Rourke's talking about there, but most of the stuff you'll be able to understand. And then it's just going to give you an idea of things you might want to focus on or talk to your tax accountant about. So or talk to us about. So that's what we're going to endeavor to accomplish today. Disclaimer, yes. So just keep in mind that this is not tax advice. It is tax topics, tax ideas. So I recommend you not run out to your tax accountant and say, hey, how come you haven't done all this stuff in the past? Or but there's things that we're going to present here that you might want to raise and say, what about this or what about that? Just things to keep in mind that you might do before the end of the year. So I guess that's all I'll say on the disclaimer. So the first thing I want to just look at is the tax rates. And these are really important because when you're doing tax planning, especially for business owners like yourselves, you've got a lot of different options to get yourself in a position where you're in a lower tax bracket. And there's costs and benefits to each decision, but the tax rates are important, the marginal tax rate. So that's one of the most important things in tax planning is how do we get you into a lower tax bracket? So the Tax Cuts and Jobs Act that came into, or that was passed in 2017, signed by the president. It basically doubled the standard deduction relative to the itemized deductions. So in 2020, your standard deduction is for each individual is $12,400. So on the first $12,400, you don't pay any tax. It's great. And then if you're married, even better, you go up to $24,800 of deductions right off the bat. So that's great. Then from there, the first 20,000 above that, you are paying. I'm just going to talk about married filing jointly. Single is, I don't know if you guys can see my mouse, but I'll focus on married filing jointly. And so the single, you can just basically cut it in half. So the first 20,000, I'm rounding from 19,750, first 20 grand's at 10%, pretty low rate. And then the next 60,000, i.e. from 19,700 up to 80 grand is 12%. So you can make, all of us can make 80 grand and only pay 12% federally, and some states don't have state tax at all. So your first 80 is 12%. It's pretty good. In my view, no one wants to pay any tax, but someone's got to fund the government, and we all got to participate. But the rates are pretty low for the first 80 grand, and then once you get over 80 grand, married filing jointly, you're looking at 22%. So it jumps up significantly in 10%. So you can make up to 171,000. At 22%. So again, not bad. And again, these are incremental. So you're not paying 22% on everything up to 171,000. You're only paying 22% on this increment. So these are marginal tax rates. So when people say, what's your marginal tax rate? It's just the highest tax rate that you're at. So 22%. So ideally, ideally you want to try and get you down into 80 grand area. That's tough to do for doctors for the most part. I don't see too many doctors that are married that are making that. There's ways to get down there, but which we'll talk about. But so then we go to 22, as I mentioned, and up to 24%. So you can make up to 326,000 or 163 for single and pay 24%, and then plus your state tax rate. So then we get into kind of the big money, in my view. If you're making 300 grand, or lots of doctors are married, they're making in that range. So you want to try and get yourself out of this range. Anything below $326,000 or anything above, you're paying 32%, which is a big chunk. Get it out. Okay, I can live with 10, 12, 22. I can't live with 24. Then I get up into 32. They go, okay, well, 1/3 almost of everything I make is going to the feds. And then we move up to the next 200,000. Basically, goes at 35%, and then 37% over 600 grand, 22,000. So in these areas, yeah, we really like to get you pushed down here. I'm sure you'd like that also. So keeping in mind your marginal tax rates are really important. And then when you add on state tax rates, for example, California goes up to their high rate is 13.3. So when you're in this range, and some doctors are, less than 5%, but I'd say in that range. Married filing jointly, I've seen over 622. So on a number of tax returns. So then with the state, you're kicking out half. So doing some tax planning, things to reduce that is great. So we need to keep in mind these marginal tax rates. I'm going to talk about these as I go through some of the strategies to get you down into the lower tax rates. So let's move forward here. I've got this information up because a lot of people, doctors, are confused about what is actually taxed. So I'll say right out of the gate that any distributions you're getting, that's not tax. You do not pay tax on your distributions. That's not entirely true in a certain circumstances. If your basis of your ownership of your shares goes below zero, um, then or the retained earnings of your entity goes below zero, then you're going to pay capital gains tax on your distributions. But you always tax plan so that doesn't happen. So when you're getting your distributions, that's not taxed. So what is taxed is so we'll just go we'll go through this line by line a little bit. So you've got your collected receipts of the clinic doing $1 million, and all these things are deductible: your cost of goods sold, your staff costs, your overhead, occupancy, marketing. And then in S corporations, which we'll talk about in a second, the owners are required to take W, a reasonable compensation. So so that gets deducted because you're taxed on that personally. So you get your W-2, you're paying all the FICA taxes, all FUTA taxes, workers' compensation tax on these wages, so these W-2 wages. Then you deduct those in your business because you're getting taxed through your W-2 onto your 1040 personal tax return. Then you can deduct interest. Oops, getting ahead of myself. And then depreciation, and then owner stuff. And owners can get a little aggressive in my view. It's okay to be aggressive, but within the law of what you can deduct. Then, so we have a net income. This could be 300,000 or 30,000. It doesn't matter, but in this case we've got 30. So that is what is taxed, not your distribution. So if you take 100 grand out in distributions, you're not necessarily taxed on 100 grand. So you're taxed on this, and if you take out zero in distributions, you are still taxed on this 30,000. So that 30,000 either flows through. I'll talk about that in a second, actually. But so keep in mind that this is the amount you're taxed on, not your distributions. And like I said, you get taxed on this net income, regardless of whether or not you take the funds out of your clinic. So that's all I'll say there, what you're taxed on. So repeating myself, you're taxed on your W-2 earnings and you're taxed on your net income. You are not generally taxed on your distributions. So, okay, let's see here. These are 4 common clinic corporate structures I see, and they all have, well, the first 3 of the 4 have different tax consequences. So we'll just go through these briefly. So the first one is the most undesirable in my view. In this situation is where a clinic is set up in a sole proprietorship. So there's no company involved. You start your clinic under ABC Optometry, and then the net income, all the net income would just flow through onto your Schedule C into your 1040. So you're taxed on that. You've got no asset protection in this situation except for insurance, which is okay. But if you don't have a corporation, an LLC, for example, and things go sideways, then the creditors can look to your personal assets. So it's better to be in. It's a step up to be in this situation, to have a limited liability company with which you operate your clinic in. And so if you're signing leases or doing any of that sort of thing, most practice finance loans you're going to have to sign personally, but typically the leases, leasing for equipment and whatnot, you don't. So definitely on those things, make sure you're signing or the agreement is in the name of the limited liability company. Because why have the limited liability company if you're putting your own personal name on it? So then you're liable for it. So this is asset protections. Still, the Schedule C, if you have an LLC, it's kind of ignored. You're still similar to partnership. You just get taxed on it personally if you're a single member LLC, i.e. one owner. So that's a little bit of a step up. You're doing a little bit better here. Not a lot of tax planning you can do in these 2 situations from a corporate standpoint. So we go on to number 3, and this is by far and away the most common. I don't think it's the ideal. I'll talk about the ideal in the next slide. Is electing to have your LLC taxed as an S corporation. So we'll talk about the benefits of that, but effectively you can save a significant amount of money on FICA taxes if you plan properly for your own W-2 wages. So we'll talk about that. So number 3 is pretty good. Like it's a good structure. Just having your clinic in an LLC, taxed as an S corp. So it can be a professional corporation, a professional association, just a state LLC. Different states have different requirements for professionals to have a corporation, but regardless, any of them can be taxed as an S corporation, elect to tax as an S corp. There's a timing here when you want to do this, but I probably won't get into that. We'll be here, we'll potentially be here all day. Maybe that's for another webinar as to, if you're a startup doctor, when you should move from here to here. So the 4th is a partnership. This gives, so it's a Form 1065. Both of these are just information forms. So you're at your S corporation or your partnership is 1065 is just, it's an information form. So the tax ends up going to you, the owner, on your K1. So less than 5% I see as partnerships, because they most want to take advantage of the S corporation FICA tax savings. But partnerships do certainly give you a lot more flexibility in terms of compensation, because you can pay the partners any way you want, whereas under S corporations you've got some restrictions on how the earnings are distributed. It actually has to be distributed, and when I say distributed, I don't mean actually cash going out the door. That $30,000, it gets allocated based on ownership. So if each own, you have 3 doctors and each own 33 1/3%, then of that 30 grand in that last slide, each doctor on their K1 would get the $10,000 allocated to them. Whereas under the partnership, you can allocate that 30,000 any way you want. So ideally, you allocate it to all the other partners and you take all the money. Well, I don't think your partners would really go for that, but you do have that flexibility. So those are the four common structures. Again, none of these things are taxed. They all get pushed up onto your 1040. These are simply information forms that you file with the government, with the IRS, Internal Revenue Service. So let's move on to what I think is the ideal structure for physicians. So you can see it's similar here, that we've just got a doctor in the S corporation, but the ideal scenario is to have the clinic in a partnership, and so all the payroll gets done here, it owns all the equipment, it does all the operations, and so instead of you owning being a partner directly, you would own your partnership units through an S corporation. And then it just flows up, income goes here, oops, go back, from here to here to here. So the reason why it's preferable, if you have partners, to have an S corporation in between, is that then you can do your own tax planning. Because if you have, say, 3 doctors here in this S corporation, you're each S corp shareholders, then you've got to pretty much agree on everything. You've got to agree on what health plans you're going to have, what retirement plans you're going to have. You're going to have to agree on what sort of deductions are going to go through the clinic. But if you have your own S corporation, then you can decide, and we'll talk about a few of these strategies as we go through here. You can decide how aggressive you want to be, what you want to run through your entity, what sort of health plans you want to have. You can hire your children, etc., parents, through your own S corporation. Whereas doing it down here, people talk, well, Dr. Bob is paying his son. Well, there's and we don't see his son doing anything, that type of thing. So having an S corporation in between is great. So practically how this would function is that you, the doctor, you're actually operating through your S corporation and charging a management fee down to the partnership. So the partnership would pay you, would pay all the partners, whatever you decide. You don't need the structure if you only got 1 doctor, but if you got multiple doctors and you got differences of opinion, this is a great structure to be in. So you as a doctor, you charge management fee down to the partnership, all the partners do, and then and then you take wages. You have to have a payroll here, so there's some administrative costs. Like you have to file 2 tax returns now, well, 3, 1, 2, 3. Everyone splits the cost. Filing this one, you got to pay for this yourself. And then you take your own payroll out of this company, and then you can split the income between W-2 wages and ordinary income, which I'll talk about the benefits of that as we move on here. So this gives you a lot more flexibility of how you're going to structure your tax affairs. So then also it's ideally you own your, in my view, that you own your building, and then as real estate, that's a great investment. You got a lot of deductions, and you want to. This is really common. I don't see this too often where the company, the property is owned inside the S corporation. You do not want to have that happen. You want to have when you buy your building, get an LLC set up, buy it through the LLC, and then any rental income. So in this situation, the partnership is paying rent here, and then if there's multiple owners, you'd split it out into the different owners. But in this case of that, it's just you, the one doctor, owning the property. So this is an ideal structure. And I've only got a couple clients that have the structure in place at the moment, but certainly it's beneficial, and I'd like to see all of them get there. But it really depends on your particular situation also. Let's see if I can get this. Okay, so now we're going to talk about 9 strategies just 9 tax strategies. Call them strategies, call them things. So number 1 is establish a home office. So there's been a few court cases now that have set forth that having an administrative home office is acceptable. The IRS will accept it. The tax courts have said that's okay. So what that means is that you can set up a office at home, and the office, it doesn't have to be a specific room. It can just be space. So you got a 1-bedroom apartment or something. You just perhaps tape off some space. But that space has to be used exclusively for business. You can't have a bed in there, or you can't have, you can't be watching TV, sitting around doing that sort of thing. It's required to be used, exclusively for business. So you can do things like, review your charts there. You can look at your financial statements there. You can pay your bills from there, from that office. You could have Zoom meetings with your staff. It doesn't matter. Just use it exclusively for business. Then once you have that set up, there's a number of benefits. First, I'll say that you can establish on a pro rata basis different methodologies. You can use a square footage method. So if you've got 100 square feet for this office, and your house is 2,000 square feet, that's 5% of the home. But that's not ideal. It usually works out a lot better if you use the number of rooms. So the IRS allows any reasonable method. So let's just say you've got 5 rooms in the house, called bedrooms, kitchen, living room, whatever, and we make one of them into a home office. So 1 out of 5 is 20%. So then you can deduct 20% of all your utilities, lawn care, internet, any maintenance and depreciation. And then what you do is you bill that back to your company, your business, and then the company pays you back. You get that money tax free, but the business deducts it. Then in addition, which is another bonus, is once you have a home office established, then and only then you can deduct your commuting mileage from your home office to the clinic. If you don't have a home office, then you cannot deduct your commute. Commuting back and forth to the office is not deductible. So establishing a home office is a great deduction. You get $3,000-4,000 into your pocket tax free every year. Could be more than that depending on the cost of your residence. So home office is number one. I'll watch the time here. So another thing that you can do is pay your spouse or children or parent. So having that S corp in between the partnership down here and you owning the S corp, you and your spouse or whatever the case may be, it sets this up well to do this. So as I mentioned, sometimes like people just talk and they'll say, well, Dr. Bob is paying his children, what's going on here? So having that entity in between sets this up quite nicely. So you have to check your state laws, your federal labor laws, but certainly you can pay children. So go back in your mind to those tax brackets and think about what tax bracket you're in. You could be in, most docs are in the 24. You get down there, but if you're in the 32%, 0% on that income is a lot better than whatever bracket you're in. So income splitting down to your children is great, but they have to obviously they've got to do things that are bona fide work. It could be filing, it could be cleaning the office, it could be whatever the case may be. You set it up properly, get a job description, make sure they're doing the work, etc. But really, they can get the first $12,400 tax free. And if you got a few kids, you can really split your income out to reduce your tax burden and bring yourself down into a lower tax bracket. So that's great. In certain circumstances, you can get if you have proprietorship or a single member LLC this is going through, you don't pay any FICA taxes or workers' comp or FUTA or anything. The children don't even, as long as they're making less than 12.4, they don't even need to file a tax return. The IRS even has a web page on this, and so does the SBA. So it's not being aggressive. It's really underutilized. So same with potentially paying parents if they're in a lower income bracket. You can split that out also. So the funds that are being paid to the children, that can go to pay for their college. You can go to a 529 savings plan. They could use it themselves if they want to buy certain toys like Xboxes or something that you don't really want to fund for them. You got to still pay for their shelter, but they can pay for certain things. So they're paying for it with basically pre-tax dollars. Paying your spouses also can be important, especially if you have children, because the child care credit cannot be taken unless the non-working spouse has earned income. The idea being, well, if the spouse isn't working, then they can take care of the children. But if they are working, then they can take the child care deduction. So it can be up to $6,000 per year if you have 2 or more children at 35%. It gets clawed back a little bit depending on your income, but still, it's just ways to get your tax bite down. Every dollar counts. So that's number 2 as a tax strategy. Now, this is not going to be any shock to anybody investing in diagnostic equipment. So you can, of course, buy an Optos, an Adapt DX, whatever you need for patient care. But it's important, I think, to look at your tax bracket, so what you potentially will be in. So you need to have this equipment in place before the year end is out. But you can do some tax planning right around now and into December to make the decision as to if it makes sense to buy the equipment now to move yourself into an earlier or lower tax bracket. So the caution I do make on this is I've had lots of conversations with doctors that are saying, well, look at I'm not making any money this year or very, very little money compared to last year, but I'm paying more in tax. Well, when they say making money, which is understandable, like the money I'm making, I feel like that's the money that's hitting my bank account. Well, if you lease equipment, then say it's a 5-year lease, you're paying $15,000 a year for an Optos for 5 years, then you don't get to deduct that. So you're still, and that cash is going to say Stearns or whoever you've leased the equipment from. So you've got less money in your bank, actually hitting your bank account in subsequent years, but you're paying more tax because you don't have this big $60,000 deduction that you're taking in year one. So it can be a little bit of a slippery slope getting into buying equipment just to reduce your tax. But if you've got the cash, in lots of situations, it makes sense to do this. But you just got to be mindful that when you're taking deductions up front, that means you don't get them later. So you can't double up. And I would take my deduction on the equipment, 60 grand, great. And as I'm making these payments, also I'm going to deduct those. No, you can't do that. So you can only deduct the original piece of equipment and the lease payments, except for a small component of the interest you can deduct. But so that's all I'll say. But equipment is a great tool. Of course, the primary reason is patient care, but you can also look at it from a marginal tax rate planning purpose to get yourself down to a lower tax rate. In 2017, with the Tax Cuts and Jobs Act, when, as I had mentioned, the standard deduction went from roughly $6,000, doubled essentially. This year it's $12,400. Again, if you're married, you're looking at $24,800. So this goes to your itemized deduction. So now the majority of people don't use itemized deductions because their standard deduction exceeds any itemized deductions. And also in 2017, the state and local taxes is capped at $10,000. That really hurt a lot of taxpayers because lots of people have property taxes in $12,000, $14,000, and they have their state tax. But all those taxes are now, for federal purposes, those are limited to $10,000. So let's just kind of run some numbers quickly here. So let's say you're capped out and most doctors end up being capped out at 10 grand on their local and property taxes. Then maybe you've got interest on your mortgage. Say it's 10,000 of interest. Now you're at 20,000, and medical expenses are also deductible, but not that many folks have medical deductions because they're limited to 7.5%. That's the threshold of your AGI. So, for example, you make $100,000, 7.5% of that, 7,500. So you can't deduct any medical expenses until they get over 7,500. So you typically have a lot of medical deductions for reasonably healthy people because you got your insurance, etc. So now we're at 10,000 for local and state taxes, and then say 10,000 of interest, and you say you donate $4,000 to your church or to your charity, United Way, or whatever you're going to do. So now you have 24,000 itemized deductions. Well, my standard deduction is 24,800, so I'm going to take the standard deduction. So that $4 grand donations it doesn't help me at all from a tax perspective. So a couple things you can do. You can stack your donations at the end of the year. So say December 31st of this year, all the donations you intend to make in 2021, you can make them on December 31 or right at the end of the year in 2020 and take all those deductions this year and then not donate next year. So, but your church or whatever, they might be looking at you kind of, well, how come you're not giving any money this year? Well, I kind of gave it all last year. And if you give a huge lump sum, for example, next you could have your money look at the pastor or the charity director is rolling around in a nice Tesla S series or something, and you go, well, I kind of meant that to go to the other reasons or other purposes. So there's a way around this. This ultimately what my point is. So there's some of you may be aware there is vehicles called donor advised funds. So what a donor advised fund is that you can stack your donations. Let's just say I normally give say $10,000 a year, and I sold my practice or I had a really good great year this year, and then with donations you can deduct whatever your earned income is or adjusted income, you can deduct up to 60% of that in donations. And this year, because of COVID, you could deduct 90. percent. So whatever, if you've got $1 million of income, then you can take $900,000 of donations and pay tax on 100. So going back to that 10,000 per year of donations example, so that's what you typically will give to your charities. So you can contribute the whole 50,000 to a donor advised fund, and then that donor advised fund. So you take the full $50,000 deduction in that year, and then the donor advised fund will distribute those funds annually or monthly or quarterly based on your direction. So then the charities are getting the money consistently over say 5 years or 3, doesn't matter. But you take the deduction all at once, and then you avoid, because if you're giving, in this case, my example, $4,000 a year, you're not getting the deduction, and so you're going to donate and be generous, like most Americans are extremely generous. You can get the tax deduction. Plus, in these donor advised funds, you don't have to actually direct them to donate at all. So if you decide one year, well, I'm not sure who I'm going to donate to, I haven't found a charity I really want to give to, the funds can just sit there, but you can still make the donation. So stacking your donations is definitely helpful depending where you're at in your giving. So retirement plans. I'm not going to. These are so complex with respect to the thresholds and whatnot. I'm not really going to get into the details of them. But in addition to planning for the future, like for your retirement, they can be used, of course, as marginal tax rate strategies in order to move your tax rate around. So if I'll touch on Roth IRAs initially. So if it's a bit of a wash in my view. If you're at around 24% federally, I would tend to put my invest in Roth IRA. So a Roth IRA simply means that you don't get a tax deduction when you contribute to your Roth IRA. So for individuals, it's $6,000. If you're 50 or over, it's $7,000. So if you're married jointly, you can potentially do up to $14,000 if you're both over 50. And then if you're in the marginal tax rate and you're still relatively young, then I would put the money into a Roth IRA, because Roths grow all the income there grows tax free. So that's great. But if I'm in the 32% range, all the way up to 37, I'm probably going to go traditional, because I'm going to get an immediate 32 to 37% tax break. So that's the way I look at these. So these are individuals, so they're on your own plan. Simple IRAs and the big daddy of them all, the 401k, those are employer-sponsored fund plans. So simples are set up for small businesses, because the 401ks they're a real hassle. They're a real hassle if you not a hassle if you're not administrating them, but you have to have meetings on them. You've got to. There's a lot of information you got to send out to employees. So for smaller clinics that don't have a big staff and you don't have a lot of time, I recommend a simple IRA. So you can deduct up to $13,500, and then you got to match, say 3% or 2% on top of that. But again, that 13 grand every year you put into an IRA, and these are pre-tax, i.e., you take the deduction, and then when you pull the money out, you're going to pay tax on it. So simple IRAs. 401ks are great, because this year you're involved in a 401k plan, you can deduct $19,500. So that's a lot of money to deduct. It can push you down. And if you're in, remember that structure I had. So with a 401k, you can deduct up to $57,000 in 2020. So you can contribute $19,500, and then you can have your company match up to a total amount of $57,500. So that's a lot of deductions, which is great. But you've got to treat all the employees the same. So if you have this 401k inside your, that bottom partnership I was showing you, or even if you don't have the 3 stacked tiers and you want to do this, it's prohibitively expensive because you got to match similarly to all the staff. There's some other rules in there, but certainly you can do some great tax planning with 401ks. So that's. I will make one other comment on the IRAs, individual accounts. You can self-direct those things. So what I mean by that is you don't have to invest in Wall Street products, i.e. like mutual funds or stocks or EFTs or just treasury bonds, because you're going to get, on average, the large cap stocks are getting, say, 10% a year, and then small cap are, say, 12% a year, which is great. Nothing wrong with that. But for example, you could self-direct it, called checkbook IRAs. You could invest in a business. You could invest in, say, rental properties. So you don't necessarily have to, but you can get 25, 30% returns on those versus, but you got to do some more work. But those are options. But again, they can help you marginal tax rate planning. So number 6. Health savings account. These are awesome. These are great. You have to have a high deductible plan to contribute. So so with our business, we have, I'm not sure how to characterize it, but a traditional plan. But I select a high deductible plan because it's not all that high. So if you have a deductible of $1,400, married filing jointly is $2,800, you qualify for as a high deductible plan. Then you can contribute in 2020 $3,550 to a health savings account. You just go open it up with Fidelity or TD Ameritrade or whomever. So you can contribute up, if you're married, up to $7,100. So you get a full deduction. Doesn't matter what your income. You could be making $20 million and you can still get this deduction. There's no clawbacks based on income. And then everything inside that health savings account, it grows tax-free and you can take it out anytime as long as you're taking it out to cover healthcare expenses. So if you have, you could pay for that deductible, your $1,400 deductible with it, and then you could pay for any other things that are not covered, any meds that might not be covered. So that's great. You could just keep it in there if you're relatively healthy for 20 or 30 years, and then potentially pull it out when for long-term care purposes and that sort of thing. So you can also give them to your children at the end. So it's so health savings accounts are great. I'd highly recommend, like if you're reasonably healthy and your health insurance high deductible plan is typically cheaper anyways. So HSAs are great. Highly recommend them. And I will say again, also with the HSAs, back to here, you can self-direct those also. So you don't have to, like I said, buy Wall Street products. You can put those into an account. I'm not going into all the details, so we'd be here all day. I could do a whole webinar just on this. But so you can put it into a self-directed HSA account, and then you can decide. You can do the same thing. You can invest in whatever you want. You can invest in Bitcoin if you want. You can invest in, it don't matter. You can decide what you want to invest in. You don't necessarily have to just, but some financial institutions don't offer that. So you've got to find, if you're interested, I could give you some names, but so HSAs, definitely do it. All right, start a health reimbursement arrangement. So these got even better in 2020. First of all, I'll kind of explain what they are. I don't see too many of these, but they're also underutilized. So what a health reimbursement arrangement is that it's an employer-sponsored plan. So you as the employer would have a plan document, and would outline in that document what things are reimbursable, what health costs are reimbursable. So in 2020, a ruling came out that health insurance premiums can also be reimbursed. So you can so it's a little hard to explain, so I'll make sure see if I'm articulating this well enough for you. But the way it works is you get the plan document, you say what in this is going to be deductible or reimbursable, so that when the employees incur the expenses, then they submit the expenses to the company. The company pays the employee for those expenses, and then the company takes the deduction. So what happens there is that then all you can decide in the plan what would be deductible. So it could, so this is one of the reasons why it's good to have that other entity up in that S corp, because if you offer this sort of plan to all your staff, it could get very expensive, because depending on what you have in it as to what would be reimbursed. Let's just say there's fertility costs, for example, that are like something might not be deductible normally, whereas you can reimburse them here through this plan and then deduct them in your company. So it's not you can't deduct say vitamins and that sort of thing, or gym memberships, unless they're prescribed by your doctor. But any medical expenses are deductible through a health reimbursement arrangement. So if you've got really high health costs that are not covered under your insurance plan, then this is a great situation, because then you can use pre-tax dollars for all of those sorts of healthcare expenses. So maybe we'll do a full webinar on that also, but that's all I'll say there. The next, I gotta watch my time. Yeah, well, we're getting really late. So I gotta go quickly on this. So I've seen tax returns where you've got an S corporation, and then because of S corporations, the owners are required to take reasonable compensation in wages, W-2 wages, and then the net income, that $30,000, flows through as ordinary income on your K-1, but that does not attract, you don't pay FICA on that, or workers' compensation on that, or federal unemployment on that. So the ideal thing to do here is to have, in an S corp situation, is to have your wages as low as possible, as low as reasonable. Because if you're pushing out, say, I've seen this many times, $200,000 or $300,000 or $400,000 in W-2 income. Well, first of all, you are paying on the first $137,000, because Social Security is capped at $137,000 this year. You're paying your portion of 6.2 off your W-2, so you got to pay that tax, and then your company is paying the other 6.2, so you're paying 12.4% tax on that. That's expensive. And then you're also paying Medicare at 1.45, your portion and the company's portion. So that total is 15.3. And then you're paying an additional 0.9% on, if you're single, 125,000, or 200 married, filing jointly. So W-2 wages are the worst kind of income we can get. So if doctors want to try and plan to have their W-2 as low as reasonably possible. So I'll give a little example here. Let's just say you're a doctor that works, you maybe you only work 2 days a week, but you've been practicing for a while, you're in your 50s or something, you're making good money, and you do some administrative work also. So let's just say your salary is, your W-2 wage is $137,000. Well, so if you pushed your wages down to $97,000, say $40,000 less, then you're going to save $6,120 in FICA taxes every year. That's a lot. It's a lot of money. And then also on anything over that, I'll just round this up to 3%. You're paying 3% Medicare on every dollar you get paid in W-2. So having a reasonable salary, you have to have in a S corp situation. So that's for the work you're doing, and then the rest flows through as kind of passive income that doesn't attract all these taxes. So that's all I'll say there because we're getting late here. Number 9, the Tax Cuts and Jobs Act introduced a qualified business income deduction of 20%. So again, remember that $30,000 of ordinary income? That gets the 20% qualified business income deduction. So if you're taking that $150,000 of salary that I was speaking of, you reduce that down to 100. Now that 30,000, you're still getting it. You get the 100,000 of salary, and then the bottom line income is now becomes 80. You take 50 off the 150, add it to the 30 bottom line. Now you get 80. You're still getting the same money, but now this qualified business income is applied to the 80,000. So now you get a much bigger deduction. So determining what your pushing income out to yourself in ordinary income is a lot better than W-2 wages. So you need to talk to your accountant, talk to me, talk to whomever about what would be reasonable under the circumstances. And there's no concrete amount as to what's reasonable. It's just based on the facts and circumstances. So ideally, you want to keep your W-2 income lower. And then in addition to that, there's one other thing that I've seen on tax returns that I've received that is not done because a lot of accountants are not really all that familiar with your profession, the optometry profession. So the SSTB is a specified service trader business. So it's a service business. So that would be optometry professional work, accounting work, law work, architectural work. So that income is limited in terms of the QBI 20% deduction. So if your income is quite high and you have a pretty successful practice, this 20% gets phased out after a certain level. So if you're single, after 207,000, married 415,000. Some practices are doing quite a bit better than this even. So then they don't get this deduction, which is kind of unfortunate. But if you split out your professional income from your optical income, which I do on tax returns that are at, if you're below this level, it doesn't matter. This doesn't make any difference. But if you're above these levels, then splitting out your optical income is important because then because this 20%, there are no thresholds. There are, but I won't take too much time to get into that. So definitely splitting out your optical from your professional business as two different streams of income, so that this 20% will be applied on 100% of the optical income. So if it's $1 million of optical income, ordinary income, not too many doctors make $1 million a year just on optical, but not that I'm aware of. So anyways, that's another planning tool. You got to make sure that's happening. So yeah, we're really getting late here. So just a few cautions. I do see a lot of, because I run tax returns for doctors, I'll just say a lot of doctors, they get pretty aggressive on putting automobile expenses through your clinics. I do not recommend purchasing an automobile through your clinic, especially if you only have one location, because you don't need an automobile to run your clinic. One clinic, you're just driving back and forth, and most supplies you just don't need it. So deducting an automobile inside of a clinic is a little risky, and then you have to track your mileage. So the only thing you'd be doing is potentially going to Costco or wherever to pick up some supplies. It's even if you have a home office, unless your office is a long way from your clinic, so you have to have at least, the only time I would put an automobile inside my company that owns the clinic would be I am absolutely sure that I'm going to be using the vehicle more than 50% for business, then it makes sense. If you're not, then the deductions are a lot less. And, you know, even if you're at 55 one year and then go below 55 or 50 the next year, then you got to recapture all those deductions. It's high audit risk too. So also with auto expenses, you know, doctors want to run their gas or whatever through their business, but you know, you get audited, they're gonna deny all that, and so just charge the mileage rate. So just do an expense report. It's 57.5% per mile. Just track it, bill that back to your company, and then get it reimbursed. There are circumstances where it makes sense to have an auto in, but also meals. So if you're just going to lunch with yourself, you stop at McDonald's or Burger King or I don't know, Subway or wherever, those aren't deductible. It has to be a business meeting. It can be a business meeting with your employees or with potential patients or whatever, vendors. Those are deductible. But if you're just going grabbing coffee every morning at Starbucks for yourself or meals for yourself, then those are not deductible. Entertainment, again, as of Tax Cuts and Jobs Act, any entertainment not deductible. So country club memberships, football tickets, theater tickets, unless you're giving them away as gifts to your those are deductible, but so entertainment in general is completely out. So just keep those things in mind. So I don't really have time to go through these because these I could do a whole webinar on each of them, but these are more long-term. I'll touch on these really briefly. Just kind of tweak your mind about them, and maybe some of you are familiar with these, but so opportunity zones. I think again it came through the Tax Cuts and Jobs Act. So what these are is that there are zones that are designated in all the states by the governor that says these are areas within the state that could use investment, and they have lower national averages of income of the people residing in them. And for example, I live in downtown Haymarket of Lincoln, Nebraska, and it's beautiful down there, the Pinnacle Bank Arena. But all the housing around it's low income, so it's designated as an opportunity zone. So what this does is that if you have a capital gain, let's just say you sell $1 million of Bitcoin because I think it's gone up over 15,000 today. So you sell all that, you got a huge capital gain. It's like the old 1031 like-kind exchanges. So then if you invest that into an opportunity zone, then say you bought Bitcoin at 100 grand, you sold it at $1 million. So you can defer that entire capital gain for up to other 5 or 7 years, and then be taxed on not the whole 900, but 85% of it. So that's great. I get to defer. I don't have to pay tax on the capital gain if I invested in an opportunity zone. So then, in addition to your investment, let's just say that $1 million you invested in a opportunity zone. It could be a business or real estate or whatever, and then that goes in the 10th year. So year 1, you go to year 7, you got to pay tax on the capital gain, and then year 10 you sell that investment. Then for another $1 million, then you don't pay any tax on the incremental $1 million. It's great. It's awesome. So there's opportunity zones that are all over the country. You just go to the map in your state, look it up. You can see what's going on. Charities are also fantastic. All the wealthy people in the world have charities. So they, like in that same thing that I just mentioned with Bitcoin, instead of potentially selling it, you could donate it to your charity. Or say you've got property that's increased, you could donate it to, you establish your own charity, donate it, and then you get the fair market value deduction. So if you paid 100 grand for your Bitcoin, went to $1 million, then you get a $1 million donation deduction, and you can carry that forward if you can't use it. And then the funds that are in your charity, just maybe you're wealthy or whatever age you are, and you don't really want to have your children have it and have access to it, but they could be employed by the charity. And as long as the charity is doing some charitable purpose, it could be, it could be habitat related, it could be just helping the poor, helping veterans, whatever the case may be. Anything the government does is a sense of charity. Anything the government does, you could do through a charity. So charity is a fantastic way to tax plan. Conservation easements. real quick on those, you got to have a lot of money to do a conservation easement, because you have to look at what they are essentially is, you have this piece of property. You don't have to own it yourself. You can invest in these, or if you do own it and you want to conserve that property into basically indefinitely. So essentially you're donating it to the feds. You control it, you run it. It's still yours in a sense, but you look at the highest and best use of that property. Say it's it's for purpose of conserving water, or it could be habitat. Like I said, a number of different reasons why you want to conserve it, for just conserving the land, for the beauty of it. So they look at the highest and best use of that property. So say it costs you $1 million, they put condos on it or whatever, maybe it would be worth $10 million. Now you get a $10 million deduction. If you so it's a lot of wealthy people are doing this. IRS is getting a little more, cracking down a little bit. They haven't changed the law, but they're just looking at them more closely, because a lot of people were being pretty aggressive with conservation easements with these things. So real estate's also great. The only thing I'll say about real estate, you get great deductions. If you own real estate, you can depreciate the whole thing down to zero. When you pass on, you give it to your children, and then it steps back up to the fair market value. So again, see a piece of property, $1 million, you depreciate it down to zero. You pass away, you give it to your kids, then it steps back up to $1 million. They can deduct the thing themselves again. So real estate, there's a lot of advantages to real estate. That's why owning your clinic is good. You can do cost segregations. So again, you buy a piece of property with $1 million, land building. Normally that's 39 years, but you can do cost segregations where you take the HVAC system, anything that's non-structural, you can deduct that in year one. So you can create losses. And if you can get your spouse to qualify as a real estate professional, it's even better, because then you can deduct the losses against other income. So to qualify to be a real estate professional, it's not a license from a real estate board or something. It's an IRS definition. You have to meet 750 hours of working on real estate in some capacity, so that you can qualify as a real estate professional and then deduct all your losses against your other income. So it's great. Oil and gas is also really good, because they have probably by far and away the most aggressive in terms of the tax law, which they've lobbied for, fair enough, to deduct expenses immediately. So you can invest in oil and gas, get massive deductions initially. So those are things that you could potentially consider, especially if you're selling a practice. A lot of boomers now are selling their practice, and so they've got some things that they could plan, and all of these things would kind of work there. I've talked a little, I've mentioned Bitcoin a few times, or blockchain technology. It's basically the next level. Blockchain is the next level of computing. So if you hold over a year, still short-term capital gains, and though that market is doing extraordinarily well. So those are some things that you can think about investing in. So that's it even went longer. So this is my email address, brourke@thewilliamsway.com. Some of you that submitted questions, I'll respond to all of those. We're not gonna have time today because I need to end this webinar, but here's my cell. You can call me or text me, no problem. If you have any questions, this is my direct line. So definitely, if you have, I love tax, I love talking about tax. So if you don't hesitate to contact me.